afternoon, everyone. Thank you for joining us for the webinar today. A few housekeeping items before we get started. All attendees are on mute. If you have any questions, please use the questions feature on the dashboard to the right to ask questions throughout the presentation. Our speakers will do their best to address as many questions as they can at the end of the webinar. Before I turn it over to our speakers, it is important to note this information is extremely fluid. Therefore, we encourage you to visit and bookmark our resources page featured on the current slide. We have multiple upcoming virtual events covering everything from PPP, cybersecurity, and strategic planning for businesses. This page is continuously being updated with resources and events as we receive updated information. At this time, I will turn it over to James Eaton, who will kick things off for us.
Good afternoon. I'm James. I'm on the left side of the screen there. Angelo is in the middle, and Brian Kirst is on the right. And we also have Pete Rigoni with us to give some thoughts and insights. Before we get too far started, let's talk about what we're going to talk about. Let's talk about what we're not going to talk about. So from a learning objectives perspective, we really want to talk about some definitional things, right? How are terms defined within the law and within the regulations? How do those apply to my situation? What guidance has come out and what are FAQs that have come out? What are the kind of standard rules for loan forgiveness? Understanding how those apply to me. And then we'd like to try to take some questions at the end, that we want to be really sensitive to everybody's time. So if that's what we're going to talk about, let's also talk about what we're not going to talk about. And there are a couple of really interesting and important specific scenarios that we need to kind of carve out. Number one, the CARES Act includes a very short paragraph in section 3610 that applies specifically to government contractors. And I think as an industry, we were all very hopeful that as the 30-day window for the Treasury and SBA to publish guidance kind of came to a close on Sunday, that we get some really clear and concise regulation on what government contractors should do and how they should interact with their contracting officers and those sorts of things. We didn't get any really specific and clear guidance there. So this is an important area, and probably an area where government contractors should seek the counsel of attorneys, specifically attorneys that are really specialized in this government contracting space, as this seems to be a quickly evolving set of questions. In addition, late last week, Thursday and into Friday, there were a series of FAQs, frequently asked questions, released by the SBA and Treasury. And one of them was specific to a number of news stories that have come out about large publicly traded companies that applied for PPP funds and got them, and now they're returning them. And there are a couple of really nebulous thoughts in there as far as what borrowers have to apply for, what certifications they have to make, and other sources of liquidity. And those are areas where there's just really, it seems to be a moving playing field every day, or really even every hour. And those are areas where we're just not ready, and I don't think anybody's ready to comment specifically on what that means. So I think our mindset today is to take the approach of, okay, I applied and I got my PPP funds. Where do I go from here? What we're not going to look into is, given these verbiage that have come out in the past 3 or 4 days, we're not going to talk about the original application and whether or not I was actually eligible for the application based on these, again, quite murky guidance. We're going to say, okay, I got the funds, what should I do now? And that's how we want to approach this sort of quick hits webinar today. So from a definitional perspective, what's the first topic we should cover here? Well, we get a lot of phone calls and a lot of emails from clients with specific questions, and we like to really try to give specific answers there. And one of the biggest things we often hear is that somebody will say, okay, well, I've got 2 months worth of payroll, or I have 2 months to use the funds, or I have 60 days in which to pay things off. Definitionally, within the law, the covered period is actually 8 weeks, which I think, if my 8 times tables work out here, is 56 days. So it's actually 8 weeks. It's not 2 months and it's not 60 days. And that 8 weeks starts on the day that the first tranche of funds comes in from the bank, from the funding bank. Now, that's important, especially maybe in the GovCon space where we may have semi-monthly payroll filings. And so let's think about what that means. The law says that the expenses should be costs incurred and payments made during the covered period, again, that 8-week period. So that's really a little bit tricky because if you pick any number of dates, what you have is a rolling 8-week period. Now, if you had all of your personnel on weekly payroll, this might not be too hard. Even bi-weekly payroll might not be too hard. But we have a number of clients whose 8-week covered period may be ending, it just happens to be a common date, on June 10th. And they say, well, gosh, what do I do with my semi-monthly payroll? Because my payroll is not payable until June 15th. Do I get to include that in the definition of payroll costs and the payments in the covered period? There's not surprisingly a little bit of ambiguity here, but there are folks out there saying that, hey, what I may need to do is do a short period payroll run through June 10th in our example, and then do another period for after the covered period, the covered 8-week period. And this is another place where the AICPA and a number of lobbying bodies are requesting additional guidance to what does incurred and paid mean. But that's really important with payroll. In addition, I think we had somebody who was good enough to kind of ask a question prior to this event, and they said, hey, can I pay multiple months rent in June, for instance? And again, this verbiage, costs incurred and payments made, and that's important that the and is not an or, right? So it says costs incurred and payments made seems to imply that the law does not want you to say, okay, I wrote a check for 4 months rent during my covered period, and now I can include that as a covered cost. That doesn't seem to be the intention of the law. So there's going to be some coordination that needs to take place between the payroll periods, expenditure periods, and making sure that the checks that are being cut are for costs that are incurred during the covered period. So for a little bit more on what the costs that are covered and how do we get into that, we'll look at Brian and we'll see if he can tell us about that.
Yeah, so now the businesses are starting to obtain their PPP funding. It is very important to know and understand what those proceeds should and can be used for. And so you can see here the 75-25% split at the top is something I'm sure a lot of you are aware of, and sort of one of the key pieces to really keep in mind over the course of that 8-week covered period that James has alluded to earlier. The payroll costs are really what should be looked at first, right? These are the costs that ultimately will be forgiven if spent on eligible payroll costs. So aside from a few other factors, but really, again, I think a good idea is to probably assess ahead of time before the funding comes in, or if you have already received your PPP funds, to take a look at and say, okay, what do we think our payroll costs are going to be for this 8-week period? So let's say, for example, you think you're going to spend $750,000 in payroll costs during that 8 weeks. Well, then that means you can spend $250,000 on these other non-payroll costs in that 25% bucket for a total eligible forgiveness of $1 million. And so one of the questions we got ahead of time was, well, does this mean, is this sort of an all or nothing loan, right? What if I received a $1.2 million loan and for the example, I've spent the 1 million, does that mean I haven't reached the full amount? Am I not eligible for forgiveness? From what we've seen, that's not the case. The $1 million portion would be forgivable, again, if spent 75% of that on payroll costs, and you would be left with the $200,000 loan at that 1% rate. And so again, it's not all or nothing. Whatever you spend on payroll, again, if it's in that eligible category, as we can see here, that portion will be forgiven. And so now you're saying, okay, I know I need to place the focus of my PPP funds on payroll costs. What is included in that amount? And so there was a lot of uncertainty at the time when the applications were going through as far as from a salary perspective. Does this mean gross salaries? Should I be taking the net portion that I'm paying my employees? Well, much like what was determined in the application process, when you're looking at what will ultimately be forgiven, it will be the gross salary piece. Okay, so that includes things like the employee's portion of payroll taxes, as well as any federal tax that's being withheld. So the list you can see here is a pretty good sized list. I'd say fairly robust. We knew about the wages and salaries, but the other components is a good list of benefits that typically companies will provide for their employees. And so one item too that is also not on this list, but I think it's worth mentioning, is that for those clients out there that are partnerships and structured at that entity type, guaranteed payments and really any amounts that you would see on your K-1 subject to self-employment taxes are included in that sort of gross salaries, wages line item component. And it's important to piece it in there because, as you can see on the next slide, it's kind of encompassed in that $100,000 prorated annualized amount. So again, another big topic of conversation as far as when the application process is going through and now looking forward ahead as to what's going to be forgiven. So what we're doing here is we are prorating that piece for all of our employees who have salaries in excess of $100,000. But very important to note, and something that came out recently, was a lot of people were asking it, does that mean all those benefits and things that we saw on that previous slide, are those going to be encompassed in that $100,000 annualized limit that's subject to that? And the answer is no. Fortunately, those costs are separated out. Those retirement plan contributions, the health insurance premiums paid for, those are all included in that 75% bucket, but fortunately that they are not subject to the $100,000 annualized limit. So very key to remember that. And then here we can see also the bottom two other items that I'm sure a lot of you run into are payments paid to independent contractors. That was not included in the eligible amount because those contractors themselves can go out and apply for PPP funding. So they made it a point to pull those out. And then anyone that's claimed credits under the Family First Act, under those sections 7001 and 7003 for any qualified sick leave, those you can't double dip. So again, kind of like the independent contractor point, we don't want to double dip in terms of benefits that we're deriving elsewhere. So now that we've covered the 75% piece, we want to know, well, what are the other components in that non-payroll cost category, the ones that I can spend up to 25% of the funding on? And so here we can see, nice that they included some of these components. These are still sometimes hefty expenses that are important to keep businesses running. So it was good that they included this amount in here, because I think it will be difficult for people to ultimately reach that 75% payroll threshold. So it's good to have other components in here that we can use the funding on in order to sustain operations and keep the business going. So now we'll turn it over to, I believe, Angelo, who will be picking up next.
Hello, everybody. We really appreciate your time. In putting this together relatively quickly, this was really in response to a bunch of questions that we had gotten on pretty much a consistent basis, because everybody's scrambling for information. We wanted to get this out to everybody relatively fast and hit specific points so that we could take some of the guesswork out of this. Precisely the information that Brian had with regard to the 100,000 and things of that nature. And so we do appreciate your time. So my section starts with the record keeping, and ultimately, it's us, the borrower, who bears the burden of proving that we've met the requirements for the loan forgiveness. And so these records are submitted to the lender and include documentation verifying the number of employees, the amount of the payroll, payroll per employee, which is very important, going back to the utilities and the mortgage and those kinds of items. You're going to have to provide verification for payments on covered mortgages and covered rent obligations, things of that nature. And the borrower has to provide certification from one of the authorized representatives that the documentation is true and correct. So, all the normal stuff that you have with a loan, and that the SBA may require other documentation as it determines necessary. So loan forgiveness won't be granted without this documentation. It's a question for us as to what exactly that means. What kind of anticipated reports can we put together that make sense for someone who's not in our business, who's looking at the information that we provide to say, okay, this company has met the letter of the law and the requirements that we put out. And again, if you think about the real impetus behind this law, which was to get money into employees' hands, payroll is going to be a big thing. Now, for government contractors, we're fortunate, or unfortunate, depending on how you look at it, but in this case, we're fortunate because of timesheets and the good record keeping that's required for us to invoice our clients. So from that perspective, what we'll be looking toward, I think, is some kind of a combination of already prepared reports for billing out our people, looking at information for those employees that aren't billable, and then segregating all of those particular employees so that you can represent that during the covered period, you've met the criteria for both having them employed and the salaries that they're receiving. One of the comments that we received was, should I set up a separate bank account for PPP funds? I think by doing that, you can say, I took this chunk of money and I applied it to payroll, and this ties into my payroll for that period. I think that might make sense. I think in some cases, setting up a separate bank account is a bit of a pain, and money is fungible. But I think that's a good way to separate the money that you got in from the loan proceeds and be able to point to specific dates, specific times, and specific purposes for doing that. So if that's not a pain for people, not a pain point, then that may be a good way to go. The other thing with regard to government contractors is the relationship to contract invoices and what we need to do to bill our people. So I think the coordination that's required for, I guess, now you're basically praying to do for two different purposes. One, the objective is to make sure that my contract doesn't get overbilled and that I bill it properly. And then secondly, for those for whom I'm not billing, that I can get the forgiveness on the PPP. Now, so the coordination of those two, I think, is super important for government contractors, especially because of the nature of how we bill and who gives us funds from the invoices. Next slide, please. And I'm going to kick it over to James, who will talk about something that came up in one of these questions, very specific to from the employee's perspective.
Yeah, so thanks, Angelo. We have, I think, in the past maybe a week or 10 days since funding really started coming through, we have moved on from, am I eligible and how do I coordinate with the bank and what numbers go into the application, to a real logistical set of questions about what do I do? And so we have worked with clients to say, okay, I've gotten my PPP funding and I know that that money came in on a certain date. And so based on that, I have a covered period for 8 weeks. So I need to get my people back on payroll. And in order to do that, I'll pay them next Thursday. Great. But the problem there can be, gosh, if they have gone out, if the employees have gone out and applied for unemployment, and if you're going to pay them next Thursday or next Friday, and that payroll period is this week and next week, well, goodness, then they're really not eligible for unemployment for this week and next, because you're going to pay them on next Friday for that payroll period. And that gets back into the famous, as we've just mentioned a few minutes ago, double dipping. So not only do we have this problem of, okay, from the employer standpoint, how do I determine who is going to be on payroll and how quickly they're going to be on payroll and how I'm going to pay them in order to fit the 75% definition of payroll costs. But we also have to think about our employees who might have been in a furloughed situation or somehow have gone along and applied for unemployment. We need to coordinate with them to let them know, hey, as of Monday, you're back on payroll. So, in 2 weeks, in a week from Friday, hey, you'll get your paycheck that covers a 2-week period. They need to know that so they can stop their unemployment benefits, right? And so most states in our area have a standard 26-week unemployment period. And I think the average, most states are then going to add 13 weeks under the government provisions, the federal government provisions under the CARES Act. So if they come off unemployment for an 8-week period of time while they're back on the company's payroll, then they can maintain the additional 8 weeks of unemployment benefits at the end of that period. Now, I think we all hope that that we're not looking at 47 weeks down the road and still having people on unemployment. I think all of us hope that we're back up to speed and 100% capacity by then. But there are quite a number of questions about that, right? And so you really have to look at, again, coordinating with your payroll periods, understanding if you're paying in arrears or if you're paying timely, and making sure that the employees have those types of questions. We also think that there's a fair number of, we'll probably see in the next 30, 60, 90 days as some of the crush of the unemployment question decreases, we may well see significant number of letters from various states. And Angelo and I had a scenario where some clients had a location in West Virginia, but the employees were mainly from Maryland, and the employees applied for unemployment in both West Virginia and in Maryland. And so once, sort of all of these things come back under control and the world returns a little bit to normal, it wouldn't be any surprise to find West Virginia sending our clients a letter saying, hey, we got unemployment claims against you in West Virginia, should you have been filing in West Virginia, and hey, please send us a whole bunch of money for your West Virginia unemployment account. So that's something to be aware of. Maybe that's not a right now, today sort of thing, but it's something that we're seeing. And of course, if we can avoid getting nasty grams from the various states, I think it's better for everybody. And Angelo, do you want to talk about full-time employees there for a moment?
Yes. So one of the things that kicks in, so let's assume that you do all the proper payroll and all the proper utilities and all that stuff, and you have everything in place so that you spent the money on where it was supposed to be spent. If during the periods that are being tested, and the slide sort of tells it all, that if you don't meet keeping your staff up to what they were before, at the levels they were before, you may end up with missing out on some of the forgiveness anyway. So one of the things that we want to point out is that if you cut your force down by full-time employees during the periods from the covered period, the 8-week period, and there's 2 testing periods going back to 2019, one of them, or early 2020, that if you drop, let's say you start out with 10 employees during the period from 2/15/19 to 6/30/19, and that's an average monthly full-time employee. Let's say you start with 10, and during the covered period where you're not sure as to whether you're going to have work at the end of the day, that you end up with 7. Even if you do everything right, there's a potential that you could give up, in that case, 30%, in my example, 30%, because you have 7 employees where you used to have 10. So there's not a whole lot of information as to what the definitions are with regard to these periods. And also a similar salary reduction where you have to go employee by employee with regard to these particular items. So one of the things to watch for as this progresses is making sure that you keep your level of employees up, and that you don't drop salaries to the point where you can't make them up at some point, or you risk loan forgiveness. Now, maybe that's not a bad thing to do if you think about maybe short-term versus long-term, that if I'm unsure and I drop 70% of my employees and I give up 30% of my loan forgiveness, but I retain the capital and I have the flexibility that I need, then having the loan forgiveness may not be the wrong thing to do. So we want to make sure that you pay attention to full-time employees, and there's to add to the confusion with regard to full-time employees, there's a restoration clause, if you will, that will allow you to bring employees back by June 30th, and this full-time employee and salary reduction doesn't kick in at all. So if you bring employees back and you meet those levels, then this regard to the salary reduction and the full-time employee reduction would not kick in. One of the things that commentators have pointed out, that if you hire somebody back on June 29th and meet this particular clause, you haven't had the opportunity to pay them during the covered period. So you have to sort of watch out. There's you're playing both sides against the middle if you do that. But it appears that, given the lack of direction and guidance, that by hiring people back before June 30th will restore your ability to get past this full-time equivalent test and the salary reduction test. So in your readings, make sure that we expect more guidance on this. We haven't had it. People are alluding to the Affordable Care Act, where there was a 30-hour full-time week that was brought up there. So we don't have answers for that yet, but please be aware in your readings that this is one of the areas that we expect at least another FAQ, which appears to be the way that they're bringing out information.
So our conclusions as we sort of work through this process is that finite guidance is murky. You know, normally what we would expect is for the law to be passed and then regulations to be promulgated and released for discussion. And you would have groups like our group, the AICPA, our national group. You would have various interested parties who would make comment, and then those regulations would be formalized, and then you'd know the rules. Now, that doesn't seem to be the case here, because we had about 2 weeks difference between when the law came out and when the program went into effect. And then we've had subsequent guidance, and this is really the hard part. We've had subsequent guidance that is contradictory to previous guidance. So the rules seem to be changing on a daily basis, and there does seem to be some portion of that that's attributable to the news and the media. So that's really important, and it's also very specific to government contractors. So we really need to be cognizant of that from an eligibility standpoint. From a record-keeping standpoint, though, we can say, hey, if we're eligible, we do have a pretty good outline for what are my real logistical guidelines to follow. Do I need to set up a separate bank account? No, probably not, but equally, it might not be the worst thing in the world to do. Being able to trace the funds, being able to understand when the expenses were incurred and when they were paid is really important. And we have a number of known unknowns. So the implication of section 3610 with respect to specific verbiage in the law for government contractors, we know that that is discussed in 3610. We don't have finite guidance. In addition, we continue to get interpretive guidance, but from the SBA and the Treasury Department in the form of FAQs, which is really tough because those are not legislation. Those are sort of executive branch positions. But we try to interpret them the best we can to understand where to go. So we'll hope that we'll get more guidance as we go along. That said, keeping in mind the 8-week period, the definition of payroll costs, the definition of the acceptable other costs, our definitions of full-time employees and how to get our folks in the seats are really the practical considerations moving forward.